Alrighty, welcome back everyone to Wook Capital Management's monthly Wook Book Club. We're gonna talk about our, 10th book of the year. So we're coming up on the end of the year, and we're gonna go through Pat Dorsey's The Little Book That Builds Wealth. Mr. Dorsey was an analyst at Morningstar, and kind of using Morningstar's framework goes through the forms of competitive advantage that a company can have, and kind of approaches thinking about what businesses to invest in very much from a long-term strategic sense with some tools behind it. So I think it's a good book. I'll summarize it in a couple minutes here, a little more detail. But Joe, if you want to get our little disclaimer out of the way, and then we can jump right into that summary and talk about what everyone thought about the book.
All right, so as our regulars know, Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual.
Wonderful. Do your own due diligence. So I'll summarize Mr. Dorsey's Little Book That Builds Wealth, the knockout formula for finding great investments. And really that phrase right there, the knockout formula, it's a pretty simple approach that Mr. Dorsey takes in line with kind of Warren Buffett's public ethos of, one, identify businesses that can generate above average profits for many years. So that's step one, is what much of the book is devoted to. And I'll elaborate on that. Step two, once you've identified those businesses that can generate those above average profits, you wait until they trade for less than their intrinsic value, then you buy. Step three, hold those shares until the business deteriorates, shares become overvalued, or you find a better investment. It should be a period measured in years, not months. Repeat as necessary. So really the book spends most of its time glancing at businesses through the lens of competitive advantage, identifying that return on invested capital, when you consider the costs of equity and debt capital, you kind of just think about what that a business can generate in returns on that for a long period of time. Some businesses can generate above average returns for a short period of time, and then those normalize, those excess economic profits are competed away. So really it's about what are the businesses, what are some of the similarities, what are some of the reasons why some businesses, and it goes through the concept, that Buffett, of course, made famous of moats, and using Morningstar's lens of wide versus narrow moats, which he gets to throughout the book, but really talking about identifying what a moat is, identifying businesses that have the moats versus those that don't is step one. Step two, then you need to have a sense of what the business is worth in order to know that it trades less than intrinsic value, and you should only buy then. It makes it sound so easy, right? If only we simplified it for ourselves and we only bought wonderful businesses at fair prices. I guess we'd just all be little Warren Buffetts out here. But I enjoyed the book's laying out of the ways in which they can have a moat, which we can talk about and obviously talk about some of the examples shared. Remember, this book was written and published in early 2008. So it was published on the cusp of the global financial crisis, great financial crisis, whatever you want to call it, GFC. And the internet had kicked in. There had been a lot of new technology companies, but in 2008, I'm pretty sure Uber didn't exist. A lot of the kind of next wave of post-GFC low capital cost companies didn't come to exist. So it's very interesting reading the book with the lens of knowing it was written 15 years ago, and a lot's changed in the world since then. But what hasn't changed are those forms of economic moats. You can have intangible assets, which could be your brand, could be patent rights, could be regulatory licenses or other. Thinking about what we've talked about in our Wook reviews with Yellow, the LTL carrier that recently went bankrupt. They had a very attractive network of their depots for their less than truckload facilities in inner high density kind of inner city prime real estate. In that case, it's that could be thought of in a way, that intangible nature to it, that you can't replace it. I guess it'd be unique. Switching costs, customer switching costs would be another form of economic moat. So you've made it difficult for the customer to give up what you're providing to them. Network economics. So we think about the credit card networks as being major beneficiaries from the size of their networks, and that moat can lock out competitors for a long time. And then, of course, cost advantages. So which I think it just conflated intangible assets and cost advantages about a unique location. So Yellow might have a cost advantage on location, although they had disadvantages on their unionized labor force. So there's different forms of moats, and you have to kind of parse it all together and have a sense for the industry, have a sense for the competitive dynamics in the industry. But you can have intangible assets, customer switching costs, network economics, or cost advantages. And there's different examples of each, and we'll spend some more time going through. But you need to have some of those to have some form of a moat. If you don't have any of that, you don't have any moat. You're probably not going to have economic returns, returns in excess of your cost of capital. So the book is split into 14 chapters, and several of the chapters are simply identifying these different forms of economic moats. Really, about half the book is identifying the moats. So, and there's some time spent on how those moats can erode, where you might be able to find them best, of which there's at least one line I really liked that, quote, "The moats that do exist in consumer services, companies like Bed Bath & Beyond, Best Buy, Target, or Starbucks," again, this is 2008 writing, "are generally the result of getting a lot of little things consistently right for years, which results in the kind of dependable consumer experience that drives loyalty and repeat traffic. It can be done, but it's not easy." It is interesting to think about that statement by Mr. Dorsey and think about someone who I know we have a lot of respect for here, Ryan Cohen. His ethos at Chewy was very much oriented, and that's how you win in consumer and retail, and these really cutthroat businesses that very few companies can deliver consistent high returns on, is to deliver a dependable consumer experience that drives loyalty and volume. So anywho, I think the book really does highlight that it's much easier to find moats in some areas than others, and that you shouldn't spend your time looking in areas where there aren't moats. So, all in all, it's a lot of thinking that, for me, as someone who has an MBA in competitive strategy, it was a nice refresher of a lot of what I think of as more core fundamental concepts, which for someone newer to thinking this way, that could be really insightful. Just the concept that there are all these different forms of competitive advantage, what differentiates you from the other players and competitors in a space, and just Dorsey laying those out with detail, with examples for the majority of the book is, I think, very helpful for someone trying to understand how to think very strategically about investing. And this book does a very good job of laying out things in a very high level way about how to make it simple for yourself. You're going to probably outperform the market if you follow these you find these businesses and you only buy them when it makes sense to buy them. There's a few examples he gave in the book. Companies have still compounded capital incredibly. He gave examples of John Deere, Fastenal, and then a couple others who maybe weren't as advantaged, but kind of talking about Fastenal's wide economic moat. And Fastenal, 15 years later, I think the stock is up, almost 400% since the book was published. So they still have that wide moat from their distribution network, which again we can talk about more. But yeah, hopefully that does a good job of summarizing the bulk of the book. Lastly, you get to the end of the book and Well, okay, so you now know how to see and identify moats and competitive advantage. Think about how those moats get deeper or narrower over time. Well, you still have these very core things you need to think about when you're valuing companies. The risk to the future cash flows, how big those cash flows are going to be, if they're getting bigger, how fast are they growing or are they shrinking? How much investment will you need to put into that business? Is it a business that requires you to buy a lot of machinery, or is it a business that is very capital light? Of course, then how long can the business generate excess profits, that economic moat? Because if there is no moat, then there should be no excess profits. So yeah, I really enjoyed the book. I thought it was a great refresher for me for some core concepts around strategic thinking. And I think for most anyone, this is a worthy read and probably worth reading a little earlier in the process rather than later. But yeah, that's my thoughts on it. Hopefully, that's a good summary of it. If I left any things out in particular that I want to highlight, um, please feel free to jump in, guys.
For me, the biggest takeaway was the theory on moats. Really well known by anyone who follows Warren Buffett, but this book really hammers it in well. In fact, the tweet I sent out about this book today was 8 different ways to identify economic moats. So I'll take a look at that tweet and really kind of share my thoughts on each point. First one was if a company has any intangible assets like brands or patents or regulatory licenses that allow it to sell products or services that can't be matched by competitors. And essentially, if people are willing to pay more for that product simply because of the brand, like say a Nike sweatshirt or an Adidas sweatshirt, that constitutes a formidable economic moat. If you can find a company that can price as if it's a monopoly without actually being regulated like one, that's also considered a wide economic moat. The best kind of regulatory moat is one created by a number of small scale rules rather than one big rule that could be changed. See that a lot with like crypto companies that, if one little piece of legislature changes, can destroy the whole business. That's pretty scary. You would consider that pretty heavy lack of a moat. Also, one point I like that it's hard for retailers and restaurants to create moats around their businesses. We've seen this over the past few years. Obviously, Bed Bath and Beyond comes to mind. One thing I did really like though was he talks about things that can be mistaken as moats, right? And this one may be controversial, right? Great products, strong market share, great execution, and great management. Now that all sounds great, right? But that's not a moat. Having a great product, strong market share, great execution, great management, that doesn't really give you any sort of competitive advantage. Rather, just the business is running well like at that moment. I can think of Twitch, which people go on there, they stream video games, and for years it was the place to be. Product was great, lag was minimal. Consumers could watch their favorite streamers for every single day, and it didn't really seem like they were stoppable in any sort of way. They had really strong market share, execution, management seemed to know what they were doing, but in comes Kick, which is a competitive platform, does the same thing, allows people to stream their video games, but they did it by offering creators more of a cut of their proceeds. So if you donate or subscribe to somebody on Twitch, the cut isn't nearly as beneficial to the creator as it is on Kick. So naturally, because this other platform had the same offering but a better pay structure, people started migrating over to Kick, and Kick started marketing and really getting the word out about the new platform. And you can just see how that market share didn't really result in an economic moat because this other platform was able to recreate the same, uh, pretty much the same website, but offer more pay to creators, and creators moved over there. So that's the one that came to mind when I heard about the mistaken moats. But yeah, biggest takeaway for me from this book was the moat stuff. So if anyone else wants to go ahead and share theirs, feel free.
Yeah, the mistaken moats also resonated with me. Sorry, can you guys hear me?
Hear you. Go ahead.
Oh,
Yes,
right.
yes,
Okay.
yes.
Because it's so easy, especially for beginner investors, when they start looking at companies, it's so easy to kind of take whatever they're saying at face value and take whatever information that the companies want to present to the investors and kind of believe that story. Which often revolve around things like, as Joe mentioned, the great products, and like large market share, things like that. And it takes a lot of effort and discipline to go beyond that and dig into the company to uncover information that's not part of the story that the company is trying to tell, but is inherently part of the business's competitive advantage, and you can only see that in the numbers. So at least for me in my journey as an investor, I definitely relied on these mistaken moats when I first started investing. Some of them worked out, some of them didn't. But it took a long time for me to realize that making investments just based on qualitative things that the company wants the investors to hear. It took me a while to say no to my own intuition to on evaluating these products and then the strategy of the company and whatnot, and really get myself to dig into the numbers, look at the statements, look at the read the reports, and really try to understand where their competitive advantage is coming from, because it's so easy to be swayed by the great products, the great branding, the market positioning, all these fluffy things that the companies throw at you. It takes work to kind of go above and beyond that, and become an investor driven by the true moats that are mentioned in this book.
Yeah, I think I'm with you there, Han. I think since, especially based off of the books that we've been reading and the way we've been approaching, I think we were like, especially for me, I've been more focused on like the other external factors other than the competitive advantages, the moats, and but in fact, that is really one of the most important things that we should be basing decisions on and ideas. It should be around the competitive advantages and the mode. So I think it was a really, like to Rod's point, it was a really good refresher. It's where we should technically start our thinking process and then dive into the weeds of the company. But I thought it was good. It was a good bet. But I do have a something that when Joe was mentioning something about the monopoly and how you can charge monopoly prices if you're not a monopoly and you can still be profitable. How is that possible? How is it possible that you're not a monopoly firm charging monopoly prices but be profitable? Like that goes against all economic theories and ideas. So I'm wondering how that's even like a thing.
Well, one company I can think of would be like Ticketmaster, all these websites that sell concert tickets. You really don't have any other choice but to purchase them through these vendors, which always upcharge and have like, you know, all these additional fees for buying through their platform, like booking fees and things like that. It's not a monopoly. There are other companies that offer concert tickets, but if you're if the concert you're looking to purchase tickets to is only for sale through Ticketmaster or one of those similar platforms, then they're essentially operating as a monopoly for that specific event.
I think that's the dominant firm that's able to charge, dictate the pricing, which typically is possible within like oligopoly environment, but in a monopolistic monopoly environment, technically you can't charge monopoly prices. Like tech with the technical word monopoly prices is just not possible. And I would argue, maybe I'm wrong. I don't know. I would push back and say, isn't Ticketmaster a major maybe the market leader in ticket sales companies, I would have to say they're definitely top three. So they're more of they set the price rather than take the price.
Yeah,
But
that's
that's not
fair. The
monopoly
example
prices.
they use in the book is the bond rating industry, which I don't have the most familiarity with, but it's on page 37. Not sure if somebody else wants to go over that one, but that's the example they chose of in short, if you can find a company that can price like a monopoly without being regulated like one, you've probably found a company with a wide economic moat. The exact words used by Dorsey.
Yeah, I get what you're saying, and I'm not denying that it's in the book, but I'm questioning the verbiages and the message it's trying to send.
Right. So I think what's mentioned in this book is that the monopolistic prices don't exactly mean that the company has to be a monopoly, but that all these moats, like the high switching costs, networking effects, and whatnot, they contribute to the firm's ability to set the prices. Um, and yeah, this is especially true in the examples that you mentioned, like the Ticketmaster example. Ticketmaster sells specific number of seats, and that's it. It's like selling a very tiny. The number of seats are limited, and they have the ability to set the price. It's not something that it's not like a consumer good that that has a set price, that people are very sensitive with the price. But it's similar to an airline in that way because they're able to kind of price discriminate in that way. But this is a result of like high switching costs and network effects, and so on and so forth. Because in an airline example, like all the miles, all the loyalty programs, all the alliances, those are high switching costs that contribute to the company's ability to control their prices, even if their product itself is comparable to another, let's say, airline that offers a lower price. But because people are less willing to move to a competitor that offers a lower price because of these switching costs and network effects, that gives the company the power to behave more like a monopoly than a business in a competitive environment. And at least that's the way that I understood that part. But yeah, curious to hear what you guys think.
Yeah, I had that same takeaway. Another example that came right to my mind when it talked about the high switching costs being a bit of an economic moat would be if talking about your internet provider, TV provider, cell service provider. A lot of them have contracts that lock you in for a certain number of days, and then on top of that, just the frustration of switching to a different phone carrier is enough to deter people away, even when prices rise, when other companies offer better deals. Like I know if I have an AT&T phone, if I was to hear that Verizon is offering a better rate, maybe it's $10 a month. I'm not going to go through the hassle of switching to save $10 a month because that's going to be a whole lot of work. So that's exactly what came to mind when I read about the switching costs being a moat.
I guess I'm trying to say that it's not a monopoly price. It's more like an oligopoly price. Because
I
if the
think
price is
that's
high enough, the switching cost, even though you're charging more and the switching cost isn't that much, and your switching cost is high, and you're saying, hey, like I don't want to go through the hassle, bank changes, they rather stay status quo. All that stuff makes sense, but you can't charge monopoly prices. The moment you do, then people will find a substitution effect, and they will find something else as the switching cost gets higher. So eventually that you can't charge monopoly prices. I think that the word in itself is incorrect.
I think you're
Right.
getting hung up on the word monopoly. And I guess on a spectrum, I would see it as you have one end of the spectrum, monopoly pricing. In the other end of the spectrum, be fully commoditized pricing. And your point is valid that pricing for businesses that have these forms of advantage is somewhere, along the spectrum towards and away from fully commoditized and towards monopolistic pricing. And depending on how strong the unique aspects of that business, blah blah blah, would be how close it gets to true monopolistic pricing. But I think just thinking about it on a spectrum of return for the business will be higher, all else equal, as you get closer to monopolistic pricing. And that's the concept that's more important to remember and to think about when kind of thinking about the business, its advantages. I think there was, in the end, chapter 12, what's a moat worth? Even the best company will hurt your portfolio if you pay too much for it. To me, really highlights, if you're really truly thinking on an investment time horizon of decades and not months or even years, like the Microsoft example that was provided was pretty interesting to me, because you had a book written in 2008. Microsoft returns had been significantly compressed or diminished, versus the intrinsic growth of the business. The stock underperformed because of that multiple compression, that speculative return aspect of the investment. So you've got, right, the investment return, you bought, thinking of yourself as a business owner, and that the business is compounding its cash flow or its return on invested capital, let's say 15%. It's doing great, but your stock return over 10 years might not be that 15%, because you bought when it had a richer valuation multiple. Buying Microsoft in the late 90s was the example used. So I think it's just interesting now, even fast forwarding 15 years after the book was written, you have what's many, some would consider, many would consider the best, or certainly one of the best businesses on the planet, Microsoft. So, and in that case, you had from 2008 to now a period of multiple compression and then extraordinary multiple expansion. So when you're talking about the investment returns, people, of course, especially when you get onto people with more trading oriented mentality and people thinking more from I'm trying to sell this to someone for more, as opposed to I'm trying to buy this business and see wonderful returns from the business. It's just so interesting to see that. And I thought the Microsoft example in the book, talking about the multiple compression and that aspect of the speculative return, especially on a day like today when the stock market just went up, like crazy. Does that mean that future free cash flows have all risen by that much? I don't think so. Does it mean that the multiples and thus the speculative return was there in the market, the multiple expansion was there today? Probably. But yeah, I mean, that and then the when you should sell, the final chapter, I think are also great to expand on beyond just the moat discussion. Because when to sell, he has 4 bullet points. Did I make a mistake? Has the company changed for the worse? Is there a better place for my money? Has the stock become too large a portion of my portfolio? That's something that we probably don't think about and talk about enough. But when to sell, obviously it's very important to try and buy with a margin of safety, as we've learned throughout the year of doing these discussions. I think starting off earlier in the year with a margin of safety. But then there's, things change, and as the facts change, you may need to change your mind. And yeah, I think it's a really well-rounded book, though. Anyway, sorry, I went off on a tangent there at the end.
Yeah, I think understanding when to sell has gotten even more warped amongst retail investors now that you have these communities of traders all, treating their favorite stock as if it's their favorite sports team and getting overly enthusiastic. They see the price go up and they just want it to keep going up. No one's like, okay, well, here seems like a solid exit strategy. This is a good place to leave. No one says that. And if you do say that in an online community amongst a bunch of traders who focus on a certain ticker, they're gonna hate you. They're gonna roast you. They're gonna make fun of you. They're gonna tell you to hold. They're going to tell you to diamond hands. So there's definitely been an increase in cult-like behavior with the rise of some retail investor communities, which is obviously part of why we try to foster our own productive discussions on this Discord server.
I mean, it is bizarre. Going back to the bottom line of what Dorsey has to say, which one thing I really liked is that he kept it very crisp. And this book is a very quick read. It's a very easy read. You don't need to be supremely competent in much of anything. I think you just read the book and really get a better grasp on, if you're truly thinking like an investor, like a business buyer, that these are the things you really need to be thinking more about, rather than stuff that people spend so much time on that's not important. But look, you have to sell at some point in time. If a stock, it's just crazy, right? And he even uses the company in the book. The company went from 5 to 100 and back to 5. I forget which company it was that he bought. That he sold a little bit of at the highs, not all of it. But I am trying to do a better job of that with my own personal investments, of looking at the entirety of my portfolio. And I know I share it on Twitter on a quarterly basis, but like looking at every single stock that I own that I made, I hopefully should have done all the work regarding step 1 of analyzing the company. If the original reason for buying is no longer valid, selling is likely your best option. Think about Playboy, PLBY, and it's like, is selling the best option? I still think the assets are just completely mispriced. Everyone seems to agree on that, but truly, it would have been better to have a more structured approach to, what, something went wrong here. Management was not executing at any level. Management could always do worse, and unfortunately they've seemingly done the absolute worst. So even though Dorsey makes the point not to overemphasize management, you do need to think about that. But I think that his point broadly, that management is less important in the long run, is true. That you could have the all-star team at the helm of an airline, and it's still going to be a cutthroat industry where it's very difficult to get high consistent returns on invested capital above that of your competitors. Whereas if you go and compete in a consumer products distribution, it was one of them. Some of these niche markets that maybe aren't as big, you're going to get better returns there, even though it might not be as sexy as running an airline. The management team isn't going to be the one that changes it. It's really going to be you, and you don't have to invest in every business. These flashy, shiny objects, we all get lured into them, but you don't have to buy everything, and you only have to buy when the price is right. And I think he made a good point in, I think it was one of the chapters toward the end, that you when it comes to buying, it's going to inherently be uncomfortable, and you also have to kind of find what works for you, because what and this gets back to some of the more kind of like philosophical and thinking about your investment style of like richer, wiser, happier. It doesn't make sense to try and stick to some strategy or technique if that does not align with how you exist and function. So you have to find what works for you. But I think it's good. Like, there's a lot of consistent messages that this book reinforced and reinforces, but with the big emphasis on thinking about the business more, which I like to do more of, and it's sometimes hard to do because we can all get so short-sighted and myopic. Right. Any other aspects of the book that anyone wanted to touch on? Otherwise, I think we could probably keep it short and sweet and wrap things up. And if you guys want to get your final thoughts in, we can do just that.
Yeah, I think that's fair. It was a pretty good discussion. I definitely enjoyed this book. I enjoyed this whole little series of books. Maybe for the next year, if we continue the book club series, we had there's another one. There's a little book that makes you rich, I believe is one of them. Little book. Little book that makes you rich. Maybe that's an interesting one. Or I don't know, maybe there's a bit of overlap. Who knows? I haven't looked at it yet. But this series is called Little Book, Big Profits. So maybe take a look at that one. Otherwise, happy to conclude this book club here. Of course, we do have the Wook and Review on Friday and the open mic on Wednesday. So pass it over to somebody else who wants to share their final thoughts.
Yeah, I've been loving this series as well. Soon we're gonna be beating the market and building the wealth and becoming richer with all these little books. I like how these books are written. This one especially, very very straightforward with examples. Very very just down to the point. Unlike like margin of safety was quite long with simple takeaways, but go into details. Whereas this one is kind of giving you the most practical solutions that you can immediately use. But at the end of the day, I think it really comes down to how we practice these learnings in our investing journey. Because when we look at companies, if we don't always think about what the moats of these companies are, it's so easy to get caught up in the mistaken moats because of the way we live in the overload of information. It's easy to get lost. So it all, at the end of the day, it's all up to us to practice these quote unquote formulas, although I don't like that word, but it is used in these little book series. But yeah, it's up to us to build the muscle and understand what it takes to find good companies.
Yeah, it was a good book. I liked it. It was easy read and something that obviously, like I said in my intro, something that kind of I've been focusing on the other things. So kind of gives you a bigger picture, focus on things that are just as important as finding intrinsic value and discounted cash flows and stuff like that. So I think the book was well picked. We have good balance of looking into numbers as well as looking at things like moats and competitive advantages and thinking about what's good selling points. What's a good time to just hold cash? Sometimes you have to be reminded of these things that sound basic that we think we already know. But so yeah, I think these are good. Do we have one last book? Yeah, we have one more book for the year, or do we not? Well, is this mic
Supposed to
working?
be Generation by Nathaniel Popper, but he delayed the book until next year, so we have yet to announce if there will be another book this year.
Oh, okay, got it. Yeah, but
Look,
good session.
oh, sorry, JP.
Yeah. No,
I mean, to build off that last comment there, if anyone catches the replay and has feedback for us, I know I've enjoyed going through, these books that we selected that for me, most were new reads, and a lot of the concepts were things I already knew, but to read them again and to really try and digest and kind of enact that into one's process is really what it comes down to have a consistently repeatable process for achieving investment alpha, right? That's the goal. So and I think that these books that we've covered in the series this year help to achieve that goal, and we would love to know if are there any ways that we could potentially make this better into the future. But regardless, at least talking to my teammates, I know I look forward to continuing this because really each one of these is just a continuation of learning. You go back all the way to the end of the book, final chapter, and Dorsey tells you, how are you going to, the conclusion more than numbers. He tells you, all right, I don't love all the ranting and raving about job reports and Federal Reserve meetings. In the case of today's market, we got the inflation report this morning that set things off to the races. He says, what gets me up in the morning is the opportunity to see how thousands of companies all try to solve the exact same problem. How do I make more money than my competitor across the street? It comes down to be a truly good investor, you need to read widely. You need to enjoy learning new things, digging into things you don't understand, getting better. It's very much an ongoing process that never ends. So if you don't enjoy it, you probably should stick with not doing it if you don't enjoy it. But it requires that work. And I think, as he says, one annual report is worth 10 speeches by a Federal Reserve chairman. You're truly just going through the exercises of appreciating the different forces, right? If you go back to, classic competitive strategy with Michael Porter and the 5 forces model, which Dorsey did kind of reach into in a little bit of how he explained some of these different moats. You just think about the dynamics at play, the bargaining power of the suppliers, the competitors. Again, the book goes through a lot of these different examples, but that's the stuff you got to spend more time on when you're thinking about making an investment in a company, and or whether you should continue to retain that investment in the company. That's the stuff that will matter over a long period of time. The speculative return, the price going up and down because the broader market did or didn't. That stuff obviously is noise, and it's real noise, especially if you're running other people's money. But if it's your own invested capital and you're able to be high conviction, you can hold through that. Or again, maybe you have to have a process to get rid of the stock. So it's all to say there's not a one size fits all, but I think aligning with the readings we've completed now for the year, because it seems like with the delay we're going to push into at least 24 before we return, that these are all little bite-sized ways to hopefully get better at your investment process over time, and understanding it's never a final state. We're always all trying to get better at that. So with that, thanks again, Han, JP, Joe, my team of Wookiees, and for everyone who tuned in and caught the replay. We certainly appreciated sharing our experiences and thinkings on the books this year with you all. So cheers, everyone. We hope to talk soon.